Hello, everyone. This is John Hannigan with Principal Wealth Partners. Welcome to our Tax Efficient Investing webinar for December 2020. When it comes to investing, it's not just how much you make that matters. It's how much you keep after taxes. Researchers examined the long-term impact of taxes on investment returns and concluded that while investment selection and asset allocation are still the most important factors affecting your returns, minimizing taxes is not very far behind. The various topics we'll discuss today are asset location, tax loss harvesting, Roth IRA conversions. And please remember, it's all about how much you keep after taxes. The first technique we'll discuss is asset location. In reviewing performance, many investors focus primarily on returns. However, what really matters for investment growth over time is after-tax returns, tailored to an individual's specific tax situation. Building a tax-efficient portfolio relies not only on selecting the right investments, but also on where these assets are placed. Here's what you need to know about asset location. Know the three main types of investing accounts. Taxable accounts, such as traditional brokerage accounts, are taxed when you earn dividends or interest, or you realize capital gains by selling investments that went up in value. Tax-deferred accounts, like traditional IRAs, allow payment of taxes to be delayed until money is withdrawn, when it is then taxed at the ordinary income tax rate. Tax-exempt accounts like Roth IRAs require income taxes to be paid on all contributions up front, but then allow the investor to avoid further taxation, as long as the rules are followed. Please use the enclosed illustration to locate which investments should be held in which type of account to maximize tax efficiency. Harvesting tax losses to offset gains in income can also help lower taxes. Investment losses can help you reduce taxes by offsetting gains or income. Even if you don't currently have any gains, there are benefits to harvesting losses now, since they can be used to offset income or future gains. If you have more capital losses than gains, you may be able to use up to $3,000 a year to offset ordinary income on federal income taxes and carry over the rest to future years. The tax code allows joint filers to apply up to $3,000 a year in capital losses to reduce ordinary income, which is taxed at the same rate as short-term capital gains. If you still have capital losses after applying them first to capital gains and then to ordinary income, you can carry them forward for use in future years. Unused losses can be carried forward indefinitely. Let's talk about potentially converting some of your retirement assets to Roth assets. And these are the factors to consider. A Roth IRA offers compelling tax advantages. You can make tax-free qualified withdrawals from retirement savings, and you're not subject to the IRS's required minimum distributions. But with these benefits come trade-offs that are important to consider before you decide whether to convert your traditional IRA to a Roth. Here are some key points. Where you will live in retirement. Are you planning to move to another state after you retire? Even if you expect your federal tax rate to stay the same in the coming years, the difference between your current and future state tax rates may matter. Required minimum distributions. Roth IRAs do not have required minimum distributions during the life of the original owner. but traditional IRAs starting at age 72 do have RMDs, except for the year 2020, where they have been waived. A conversion of some or all other eligible amounts to a Roth IRA will reduce or eliminate your need to take RMDs and may allow you to pass more of your retirement account savings onto your heirs. The 3.8% Medicare Surtax. Married couples filing jointly with a modified adjusted gross income of more than $250,000 may be subject to a 3.8% Medicare surtax. The amount you convert from a traditional IRA to a Roth is treated as income, just like all taxable distributions from pre-tax qualified accounts. Therefore, the conversion amount is part of your MAGI, and it may move you above the surtax threshold. But once your money is in the Roth IRA, the shoe is then on the other foot, because non-taxable withdrawals from a Roth IRA are not part of your MAGI. A Roth IRA conversion may potentially enable you to limit your taxes down the road. Leaving money to heirs. If you're planning to leave retirement savings to heirs, consider how it may affect their taxes. Inheriting Roth IRA assets, which generally do not incur any income taxes, can be a benefit to your heirs. In addition, the income paid on a Roth IRA conversion may also help reduce the size of a taxable estate. But there are many details to consider. For example, if your heirs are likely to be in a much lower tax bracket than you are, it may be advantageous to leave the assets in a traditional IRA. That's because it may be better for them to pay lower taxes in the future than for you to pay higher taxes now. How would you pay for the conversion? A Roth IRA conversion has a cost, which is the income taxes on the amount you convert. It generally makes sense to use taxable assets rather than proceeds from a converted account to pay the tax cost of the conversion. This is because, all things being equal, the rate of return is generally higher for a Roth because no taxes are due for any gains in a Roth IRA, and taxes reduce the returns you achieve. This concludes our tax efficiency webinar. As always, please contact us with any questions you may have, and thank you for listening in.